Hi, and welcome back to the part 2 of our presentation in the topic area of quantitative methods for your CFA Level 1 curriculum. And today's topic being rates and returns. Now, in the part 1 of our presentation, of course, I gave you the brief introduction about the relationship between money and time. We talked about different kinds of interest rates, beginning with the simple interest rate and the compound interest rate, the relationship between that of the future value and the present value. And in terms of the cash flow additivity principle, which of course is going to play a major role when you would learn great deal about bond market. I also took you through the perspective of the intrinsic net worth of a given investment that bears interest. And then we talked about the different interest rate regime, what is meant by the effective annualized interest rate, and how do we compare investments or different interest rate regime in order to glean through a suitable investment for us. So from here, now we talked about the continuous compounding as well, in contrast to the discrete compounding. And as you would know, in case of continuous compounding, the compounding frequency is deemed to be infinite in nature, and precisely why we use the E function, that is the exponential function. Now, from here, we are going to talk about the other aspect of the interest rate, and that's got to do with something known as the required rate of return or the asking rate. What does that mean? So, I'll just read out this particular slide just in case, it makes any sense. So to begin with, the interest rate that you and we deal with is known as something called as the nominal interest rate. Okay, so this interest rate, of course, talks about the risk-free rate of return, risk-free rate of return. And to this risk-free rate of return, we are going to add something called as the expected inflation. Expected inflation. That this is the definition of the nominal risk-free rate of interest, or the nominal interest rate in short. Risk-free rate of interest. Okay. Now, here a point of difference that needs to be mentioned is the risk-free nominal rate of interest is really not the rate in which you and we actually deal with. Now, you would be naturally intrigued to ask that what it is all about, because in the part 1 of our presentation, we did talk about how the bank rate actually proxies that of the nominal risk-free rate of interest. Well, the reason being that most of the banks that you can think of, they're backed by the central bank of a country, which guarantees that just in case, because the banks are also a depository institution, that means that they are allowed and authorized to collect money from you in terms of savings deposit, and then thereafter they perhaps could circulate that money for business purposes through the means of lending. Now, should there be any default along the line in the process of business, the central bank of the country stands guarantee that the investor, that is the depositors, capital is protected. Now, precisely the reason that we deem the bank to be risk-free, but in reality, in an absolute terms, banks are also not risk-free. I mean, you can think of the nationalized bank or even the privatized bank. Even to a minuscule extent, there exists an element of default risk. Okay, so in the strictest term, it's only the sovereign issued bond in the market that should be deemed as risk-free, that carries or that bears the risk-free rate of interest, because the government in principle is supposed to stand guarantee to the loan that it issues to the general public. So for example, if the government of a given country, for example, government of India, or you can think of any sovereign, they issue the sovereign bonds in the form of gilt, or in the form of any other treasury securities, collateralized treasury security. They issue periodic bonds and collect money from the public. And this money, of course, are being utilized for infrastructure development, supporting many businesses which are of national interest, including that of the defense budget and the government spending and so on and so forth. I'm not getting into the thick and thin of the economics out here, because this lecture is about quant. I just wanted to bring in the flavor of different kinds of interest rate and the perspective of interest rate, the how interest rate is also being perceived as required rate of return, as well as the interest rate as a proxy of something known as the opportunity cost. Now, each of these things we're going to learn in details. But before that, I want all of you to pay special attention to this particular slide. And I just stated that the nominal risk-free rate of interest. Now, here, a thing is of major importance is that we are talking about nominal risk-free rate of interest, not nominal rate only. So when we talk about nominal risk-free rate of interest, that is risk-free return, that is the real risk-free return plus the expected inflation that is embedded in it. Now, with the background that's been given, let me take you through the whiteboard and explain the nominal interest rate in detail. All right, so I hope I hope my whiteboard is visible to all of you. So just to rehash the point that when we talk about a given bank and the bank's interest rate that the bank provides, we term then, practically speaking, that they are a proxy for the risk-free rate of interest in a given country. Risk-free rate of interest. Sometimes this is also being talked about as the treasury rates. Now, this risk-free rate of interest has got two components. One is known as the real risk-free rate, and another is known as the expected inflation. And I also mentioned that this is as close to what we can get to the nominal risk-free rate of interest, nominal risk-free rate of interest. This is closest to what we could get. Now, the point that is being made out here is you and me, when we deal with any institution, whether it be bank, whether it be a private issuer of debt, we really do not deal with the nominal risk-free rate alone. Why is it so? So, for instance, we also need to visualize that, let's say, if let's say there is a corporate issuer in the market, and the corporate issuer in the market would issue something called as bond. More often than not, these bonds are also known as they're also known as the corporate bond. Now, these corporate bonds are also further classified as something called as the investment grade corporate bonds, investment grade corporate bonds, and then it's being also classified under the speculative grade. These are the two major classifications. Typically, when we talk about investment grade corporate bonds, these are those securities that would bear the rating anywhere between a triple A and triple B. So it's being widely debated that securities, that is fixed income bearing securities having these kind of ratings, are least likely to default in their promised payments, whether it is the coupon, the periodic coupons that the bond is supposed to pay, or the final principal amount, which we term as the face value. In fact, the face value and the principal amount, they need not be always identical. Again, not central to our topic under consideration. Suffice to say that these are those bonds that are expected to have the least of the default risk. However, at the same time, we must understand that as we go down the ladder, the riskiness of the bonds may also increase. And precisely why you would see that bonds bearing rating of double B or double B plus to single B, then you have C plus, and then C, and finally something called as the D class bonds. Of course, these are the bonds that exist in the market under the speculative grade, offering very high coupons, sometimes up to 20% of coupon to even 25% of coupon has also been heard of. What I'm trying to tell is that as we go down the ladder, of the quality, the riskiness of these bonds or these interest-bearing securities also increase. And as they increase, and if they are to sustain in the market, of course, they will have to compensate the investor with a higher required rate of return. Required rate of return. Okay, the required rate of return in this parlance is exactly a mirror image of what an interest rate is all about. Now, you would be tempted to know that which are the components that actually increase the riskiness of a given security. Well, first and foremost, as we have already mentioned, that the immediate or the imminent default risk is, of course, of paramount importance. But this default risk is not the only significant factor. Okay, so there are other factors. For example, there is something called as the liquidity risk. How easy it is for you to actually sell the securities in the market and not hold the security up until its maturity is known as a liquidity risk. If you're able to hold the security, if you're easily able to dispose of the security in the market, in the capital market, and of course the liquidity risk is less. But in case if it is not so, then you might have to undergo some sort of rebate or some sort of discount to the market value of the security in order to dispose them off. Addition to this is something called as the maturity risk. Why we are talking about maturity risk? It is simple, and it of course is common sense that if you are lending somebody for 5 years, vis-a-vis you're lending somebody for, let's say, 7 years, where the riskiness of default exists more, your answer is obviously going to be 7 years, because the longer the maturity, longer is the uncertainty that the issuer of the debt or the lender or the borrower whom you have actually lent the money is obviously going to return you the promised cash flows, including the face value or the principal. Which tells us that if we combine all of this risk, of course, there are a few other risks also, which I'm not going to get into detail of because those are more pertinent and more relevant when we study fixed income. Suffice to say that only pertaining to these three risks plus the inflation risk, if we add all of them, then of course there is something going to be something called as a premium that it gets built into any sort of interest-bearing security in the market. So if the default risk is high, the required rate of return, and for all practical purposes, I'm going to term this required rate of return and the interest rate one and the same thing and use them interchangeably. So the required rate of return is directly proportional to all of these subcomponents. If the default risk is high, the required rate of return is obviously going to be high. If the liquidity risk is high, similarly, the required rate of return pertaining to that portion of the premium is obviously going to be high. And so is the case with maturity premium as well. And to all of that, if we add the inflation, that defines something known as the nominal rate. So there is a difference between the nominal risk-free rate and the nominal rate. You and me, mostly we deal with a nominal rate. Whenever we deal with, think of it that if you're borrowing from the bank, then obviously it is on banks, it becomes a bank's problem and bank's headache, so to speak of, that you might actually potentially default in your in your required payment. You might actually at some point in time in future, it's likely. So bank obviously needs to build those premiums into the model. If the loan term is of higher tenor, of course the required rate of return is, or the interest rate, the pertinent interest rate will go up. If the liquidity risk is high of the given security, again the required rate of interest will go up. So all of these things are actually factored in, and that presents what is known as the nominal rate. Always remember, you and me, we do not actually deal with the real risk-free rate of interest. That is impossible. The real risk-free rate of interest is just a notion, and those notion is just being used as a benchmark. And the closest that we can use as far as the as far as the risk-free rate of interest is basically the risk-free nominal rate of interest, which more often than not is proxied by either government or by the government issued security or by that of the bank. That's the key takeaway from this particular slide. Now let's revert to our slide once again. I know I've spent considerable amount of time, but again, as before, Some of the slides, some of the topic areas, or some of the LOS is well integrated to the other topic areas as well. So it would obviously beggar a little bit more explanation. That's all there is to it. All right. So let's now talk about holding period return. And holding period return is, there are two things that I want to talk about as far as the holding period returns are concerned. The first of which is the holding period return, or HPR, is not necessarily annualized. What exactly am I talking about? Well, come to think of it, so far hitherto we talked about that whenever the interest rate is being mentioned, de facto the interest rate is deemed to be annualized, presented to us, unless otherwise specified. But the holding period return need not always be annualized, not necessarily so. All that it says is that between two periods, if the beginning value is, let's say, uh, if the beginning value is a V0 and the ending value is V1, then all that we are saying is that the return, or the holding period return, is going to be V1 divided by V0, where V1, the components of V1 can also be further split into capital appreciation, plus any interim cash flow, plus any interim cash flow. Okay, so to put things into perspective, I'm going to put this as part of an equation. So for example, if let's say I bought a particular stock at $20 and I held this stock for only 6 months, and 6 months down the line, I sold this stock for $25. And in this 6 months, the company also issued me a dividend of $4. So my holding period return is going to be 25 plus 25 plus 4 minus 20 divided by 20. Okay. So if we solve this, it's going to be somewhere around, I think somewhere close to 40%, if I'm not mistaken. Just a sec, I'll have the calculation done at my end. 45%. So this 45% is not annualized. This is a pure absolute return that has been realized over a period of 6 months. That's the definition of the holding period return. To put into formulaic form, the holding period return can be expressed as the ending value for that particular period, end value, plus interim cash flow minus the beginning value divided by the beginning value. Or in our parlance, we could note this as V1 plus D1 minus V0 by V0, which can further be stated as a V1 plus a D1 divided by V0 minus 1. All right, so let's, I leave this thing to you. There is a problem that is being set. Suppose you acquire a share at $10 per share and then sell it 3 months down the line for $11 while receiving a dividend of 0.25. We have to calculate the holding period return, and it is straightforward. And please notice that the 3 months here plays no role at all. So 11 plus 0.25 divided by 10, or 12.5%. All right. From here, let's now talk about different kinds of mean. And in particular, there are 3 means of prominence importance, starting with something called as the arithmetic mean. And then we have the geometric mean and the harmonic mean as well. In addition, there are a couple of means also being talked about. One is known as the Windsorized mean, and another is known as the trimmed mean. Now, let me tell you, because the text is something which you could read out for yourself, but let me just build certain background of all these means and where they are more suitable. When we talk about average, we are basically plain and simple, we're talking about the summation of all the data points that we have at our disposal divided by the number of data points that we have. So in the numerator, the magnitude or the value of those data points added together divided by the number of counts of the data point. That's what is known by the arithmetic average or the arithmetic mean. And by and large, this is what we talk about colloquially, informally, when we talk about average. But there are a few other types of average that exist, and we also need to learn about them because they are covered in your curriculum. You see, the problem with this kind of average is that the arithmetic average or the arithmetic mean exerts equal weightage to each of these data points. Now, what exactly am I talking about? Suppose we have got a data set. Now let's say this data set is split out as, let's say, -4. Then you have, and I'm arranging it from lowest to highest in an ascending manner. So -4, -1, let's say 2, then 6, then 8. If I have to ask you to calculate the average of these value, so you would simply add all of them and divide it by 1, 2, 3, 4, 5, 6, 6 data points, right? That's exactly what we are going to do as part of calculating the arithmetic mean. So far, looking at this particular set, looking at the distribution, it seems that this is a plausible solution. There is nothing wrong about it. And there is nothing wrong about it. But come to think of it, that I give you another data set with the same frequency of 6, but now it looks like this. So you see that even though now we have the same 6 data sets, there are certain extremes. The extremes, although feature in the negative half of the data, but nonetheless, they are widespread out from the rest of the data point. It seems that the the extreme right 4 data points are more homogeneous as compared to the first 2 data points, which are negative. Now, if you're going to take the average of, it's a simple arithmetic average of these 6 data points, of course, you will be arriving at a certain value. Unfortunately, that certain value may not be the true representation of the given data set. Why? Because the homogeneity is lost. You could think of the application of arithmetic mean by also judging the salaries. So if I say, for example, there are 3 friends, and let's say each one of them earns their annual package salary package is 150K US dollar. Another one's is perhaps 200K, and another one being 275K. Can we find out an average of these 3? Of course, we can find out. And even though we understand there is considerable difference between these, the last 250 and 275K, it's almost a double. Still, we may actually find out the average and say that the average is a good representative or somewhat of a fair representative of these 3 salary points. Imagine the same scenario, but this time around, I give you the data point of 150K, and then the next being 500K, their annual salary, and the last one's salary being 2.5 million. Of course, you can think that right now, if we find out the arithmetic mean by simply taking the arithmetic average, that average, whatever that value comes out to be, is remotely remotely connected to the true representation of all these 3, right? Why this happens? Because of something known as the outliers. The outliers in any given data sets are basically those extreme values spread out at either end of the data distribution that actually heavily influence the averages. And this is precisely where the arithmetic average actually fails to do justice as far as representation of a given data set are concerned. On the other hand, mostly when we deal with, let's say, interest rate, let's say we're talking about returns, let's say we're talking about a funds return. When a multi-period funds return are in question at that particular point in time, we do not use the arithmetic average, but what we use mostly is known as the geometric mean or the geometric average. On the other hand, we will talk about the harmonic mean as well, or the harmonic averages. The harmonic averages are best suited when we have to actually discard the effect of the outlier. Why is it so? Because as you would know, that as we have already stated that the arithmetic average by its very definition will give 1 by n weight to each of these data points, isn't it? You could simply expand this WXI out here, and you can think of that is 1 by n weight is being given, which is a uniform weight to each of these data points. So come to think of it, to each of these data points in this particular distribution where my cursor is being exerted 1, 2, 3, 4, 5, 6. So each of this distribution has a weight of 1/6, right? Similarly, out here, each of these data point has got a weight of 1/6 when we carry out the arithmetic averages, right? And but we already talked about the ills of arithmetic average rather than the limitation of arithmetic average when we deal with extreme outliers, and that is precisely where the harmonic mean does its jobs fantastically. What it does is systematically it is going to award lesser weight to those extreme outliers. How is it so? To come to think of it, if you, let's say we're talking about this particular distribution starting with a negative of 217 followed by negative of 1070 for 28 and 42. So harmonic mean is going to give a weight of 1 by 217 to the first data point, 1 by 107 as the weight to the next data point. Of course, it's going to give a value of zero. It doesn't quite figure out as far as the harmonic mean is concerned, but nevertheless, all that I'm trying to say is that the larger the data points are spread out in the extremes, lower is going to be the weight, and that is where the harmonic mean does the job. Certain financial data, for example, rate, for example, ratios like PE, PB, these kind of ratios where or multi-period stock buying and selling, whenever these calculations are to be done in order to find out the average stock prices, we make use of the harmonic mean. The Windsorized mean and the trimmed mean are actually a sub-step examples or extension of the harmonic mean itself. They are systematically, but with an agenda, they are being utilized to trim out the extreme outliers, but with an agenda, as I said. So what they would do is that, for example, if we have for a given data set, let's say we have 100 data points. Now, in this 100 data points, if it is determined that 8 data points, four on each side of the central data point or the median value, if they are extreme outliers. So what the Windsorized mean is going to do is that systematically it is going to discard this 4 data points from the left side, 4 data points from the right side, and only calculate the mean, whatever that mean be. It could be, of course, harmonized mean only. So it's going to only consider the middle portion 96 data point because it's going to deal with those homogeneous data. All right, so this is what your Windsorized mean is all about. Similarly, the trimmed mean, what it does is not always we are going to get the extreme outliers, as we have stated before, that we are not going to get extreme outliers asymmetrically spread out in and around the median value or the mean value. Sometimes it could so happens. For example, if we consider again, go back to this particular spread distribution where my cursor is, you would see that it's a left-tailed heavy outlier data in our distribution that we have got. Why? Because on the right side, starting from the point of value of the 0, of course, you could understand that there are 4 data points, even though the positive data points are also well spread out. But in the context, of course, they seem to be more densely packed, more homogeneous as compared to the left to extreme data. So in case of Windsorized mean, what we would do that we are going to systematically abandon the extreme values from the negative side as well as the positive side. We are going to discard from here and we are going to discard from here as well when it comes to Windsorized mean. But the trimmed mean, on the other hand, what they are going to do is they are going to discard the data points which tilt the outlet, which tilt the average at their end. So if it has been determined that on the negative side the tilt is more, so the Windsorized mean is going to debar these two extreme values, and if there be available another couple of values out in this data set, so it's going to consider those two data set, even if those two data sets seem to be a little bit more extreme outlier, a little bit on the outer side. So all that I'm saying is that it favors one sort of outlier over another just to temper the effect of the outliers. So that's what the trimmed mean is all about. And I know that it kind of feels a little heady listening to all these verbals that I'm talking about, but then I gave you a good background. The slide is in front of you to read through all of this, because it's otherwise it's pretty simple for me to actually do it. What I'm going to rather focus upon is how this arithmetic means and geometric means actually are being calculated. All right, so the simple arithmetic average, I'm sure that you don't require my assistance in order to drive home the point. Let's just talk about the geometric mean. So let's say we are talking about, let's say, a fund, and that fund has, we're talking about really 3 years period: first year, second year, and the third year. And we're going to map the return. So let's say the first year, the fund actually generated a return of 10%. The next year, the fund generated a return of -5%. And the third year, the return is let's say around 12%. So looking at this, if I were to ask you that calculate the mean, and if you calculate the arithmetic mean by simply taking the average of 10%, -5%, and +12% by 3, of course, this is not going to be a true representation. Why is it so? Because when we are talking about return for a given investment, of course, we are talking about the return, considering these returns in a compounded manner. I hope that I need not repeat myself, because we are well versed with the effect of compounding. And when you talk about the arithmetic mean, it's a pure number that we are talking about, which does not take into account the compounding effect. So to do justice, the return measure that we would be using is the arithmetic mean. But here comes a little bit of a problem. And the problem is that when uh, you do 10% into minus of 5%, because these are geometric mean, so you're going to calculate into 12%. When you do that, and then you're going to take the 1/3, because there are 3 data points, so you're going to take the 1/3 of this in order to find out the geometric mean. You already would understand that within this bracket, there is going to be a minus sign, right? Now, with a cube root, minus sign could be dealt with. But what if there are 7 data points and you have a minus out here? So then in order to find out the geometric mean, you would be taking the 1/7 root, the 7th root, and then within the root, under the hat of this root, you could put in this 7 data points, and then this series is going to become a complex series because of the negative sign. Now, there is a trick that is being used in order to overcome that, and that trick is pretty elegant in nature. What we do is we add 1 to each of this 5%, 10%, and 12%. Remember, when we add 1 to all of them, effectively, we would be first converting them into decimals, into their true decimals. All right. So this 10% would become 1 plus a 10%, or 1.1. So this 1 plus of -5% will become 1.05, and 1 plus 12% will become 1.12. Now, what did we achieve out here? By doing so, we forced these data points return, regardless of the actual return, to be positive. All right. So now we know it for a fact that whenever we do the multiplication, those multiplication is obviously going to have a positive value under the hood out here. So with a positive value, it will not matter what root that we take, because it at least is not going to yield a complex number. And the last step towards this geometric mean is, because we had artificially manipulated the data by adding 1 to them, after taking the nth root, we just need to deduct that 1 out here. All right. So this is how the geometric mean is being calculated. And I know that even your textbook in the CFI, they will not explain the way I did explain, because there is just no scope. They would simply give you the formula and will not explain that why the formula is like that. But guys, if you do learn like this, there is no need for you to memorizing anything. So let's just play with the number. So as I said, that we have got a 10% return, -5% return, and 12% return in succession for 3 years. We have to calculate the geometric mean. We know for a fact that arithmetic mean is not the right treatment, because it is going to systematically discard the compounding effect. That is why we need and we must use the geometric mean, because the geometric mean is going to take the compounding effect into account. So when you do that, it is going to look like 1.1 into 0.95. Okay, because this is I'm sorry, this I'm writing as 1.05. This should be 0.95. So which is 1.1 into 0.95 into 1.12 because there are 3 data points. So we need to take the 1/3 root of the same. And let me just work through my calculator first. In the meanwhile, you could also attempt the math at your end. All right. Just a sec. Oops, my battery just conked off. Just a sec. Yeah, I think we're better off now. All right. So if you do this, the third root is going to come out as 1.0533. All right. So all that we need to do is to deduct the 1 from here, and we're going to get a value of 0.0533, or in other words, 5.33%. Watch, despite having 2 very good years in return, just because of the second year, which was actually a disaster, the fund's overall performance suffered and returned only 5.33% on an average every year. All right, so this is how the geometric mean is being used. And the ones that are inclined towards memorizing formula, so for them also, I could use the formula out here just for your satisfaction. So the geometric mean could be expressed for X data points. We could express as 1/nth of the data and 1 plus xi into 1 plus, this is x1, this is x2, 1 plus x3, so on and so forth, up to 1 plus xn, okay, minus 1. So this is your formula for your geometric mean. Arithmetic mean formula, I don't think I need to tell you. And now let's talk about the harmonic mean. And you would already know, and as it has been written out here as well, that the harmonic mean gives a lower weight to extreme observation. And how does it do that? This is the formula. This is the formula. And you would be able to see that the greater the magnitude, lesser is going to be the weight, because this is the reciprocal being taken in the denominator and been added back, right? So this is how harmonic mean actually plays a role. So let's just solve a few problems, and while I solve the problem, I'm going to first solve the problem in the common sense manner, and then we will apply the same logic through a harmonic mean and check for the value. All right, so now we're talking about an investor. He acquires $3,000 worth of stock at the end of month one, priced at $20 per share, and then purchases another $3,000 of the same stock at the end of month two, priced at $25 a share. And we are being asked to calculate the average cost per share for this particular stock. Now, for a moment, let's just forget that there exists any sort of harmonic mean. And for brevity's sake, what I'm going to do is I'm going to take you to the whiteboard so that we don't get biased. And maintain the sanctity of our. Oops, just a sec. Yeah. All right. So we defaulted to our whiteboard. And let's rehash the problem, summarize the problem. We have got 2 months, and the investor is buying a share. So he buys the share price first. We will see it's $20 for the first month and $25 for the month number 2. And the investment that is being made is $3,000 in month 1 and again $3,000 in month 2. So from here, we can first find out the number of stocks. Do remember, I'm not applying any of the harmonic mean formulas that's being mentioned out here. I'm just trying to solve this problem through a common sense. Because the question that is being asked is that what is the average purchase price for the stock? Right? That's what we are out to find out. So it's not hard for us to understand that the number of stocks being the total investment divided by the number of shares, the share price, per share price. So of course, you would be buying 150 shares out here, right? And for the same reason, we're going to buy 120 stocks here. So now let's calculate what is the average price of this stock after 2 months, right? So the total investment, average price should be equal to total investment in absolute term, of course, divided by the total number of shares, right? So the total investment that's being made is $3,000 plus $3,000 over a period of couple of months. So that is $6,000, and the total number of shares being bought is 270. So all that we are required to do is to divide 6,000 by 270, and we're going to get a value of 22.22. Okay, so this is our average share price. Now let's see what the harmonic means formula tells us. So the harmonic mean or HM in short tells us the average price in this case, is going to be equal to the number of months out here. Sorry, which is N divided by the price of each of these stocks. So initially it was P1, the reciprocal of the same. Okay, so the number of so the N out here represents the total number of stocks that's there, and the price P1 reflects the price of the stock in month 1 per share, and P2 reflects the price of the stock in month number 2. So it is 2 divided by one share would cost 20 rupees, 20 bucks in month 1 and 25 by month 2. Let's do the calculation out here as well. It's equal to 2 divided by 0.09. Which will give you a value of 22.22. This exactly coincides with the value that we have got out here. The interesting thing out here is that here we really need not take the number of shares into account. All that we need to understand is the number of data points or data points, the number of instances that these transactions actually took place. So in out here, N represents the number of months, not the number of shares that we are talking about. N represents the number of months. And how many months are there? There are month 1 and month 2. And in these 2 months, even if you had purchased one share each, you would have still ended up with the same average price. So what the harmonic mean did is it actually systematically discarded the pure absolute investment value. You'd see that the $3,000 of investment did not figure out anywhere. Why? Because $3,000 could be your investment, somebody else's investment could be $30,000. It matters not. For harmonic mean, the person who buys only one share versus the person who buys 100 shares vis-a-vis an institutional fund that actually buys in shares in hundreds of thousands in a given month. For all of them, the harmonic mean is only going to consider one share at a time. And N out here, the capital N out here is the number of months out here. That is the number of instances or the data point in our consideration, or the frequency, whatever you want to call it. And in each of this frequency, what is the price per share, a reciprocal of that being taken into account, that sits in the denominator in an additive fashion. That's what harmonic mean is all about. And that is exactly how it actually tempers the ill effect of the outliers. So I hope that through this simplistic example, I've been able to drive home the point. Now let's revert to our um, screen. All right. All right. So you'd see that the harmonic mean has been stated out here in this fashion. Now, a couple of things is that I wanted to tell you is that in a given data set, all other things remaining constant, the arithmetic mean is always going to be the greatest in value. Why is it so? Because of, again, one simple fact, that arithmetic mean will give equal weightage to all the data points regardless of the data size in magnitude. That means the extreme outliers that we were talking about, that will also have the same weightage as any other homogeneous data which we calculate and deal with arithmetic mean. The geometric mean, on the other hand, is more suitable when we are talking about multi-period and multi-period kind of returns, because it takes into account the compounding effect. The harmonic mean, on the other hand, is more suitable when we will have to systematically discard the effect of the outlier. So in that regard, harmonic, the least value is going to be with the harmonic mean. Highest value is going to be with the arithmetic mean, and the geometric mean is going to lie somewhere in between, with the relationship that AM into HM is equal to GM squared. Now, this is a very powerful relationship, especially from the point of view of your exam, because you might be given, it could happen that you might be given a couple of values, for example, the arithmetic mean as well as the harmonic mean, and you would be required to calculate the geometric mean. So forget not the relationship that the arithmetic mean into the harmonic mean is equal to the geometric mean square. So all that you need to do is to, if you're given two values, you can always find out the third one. All right. So when to use where, this is a classical exhibit I have actually copied from the CFA Institute's curriculum book itself. I hope that I need not explain on this any further than what is already there. But for brevity's sake, you could pause this portion of the video and watch it for yourself. All right, so from here, we now boil down to, I believe, what is the most important aspect of this particular chapter, and that is the time-weighted rate of return versus the money-weighted rate of return. Imagine you are an investor. So, and you invest into a particular fund, in a given fund. And of course, uh, you're going to calculate and enumerate the return on an annual basis, and you would measure the performance of your fund, or your portfolio rather, in the context. Now, the fund, as we are talking about, is a publicly floated fund. Most often than not, these are known as the AMC vehicles, right? It could be a hedge, it could be a mutual fund, for all you know, where redemption is instantaneous. You could sell out your units in the market. You could buy the units from the capital market. There practically no restriction whatsoever, so long as the fund is regulated and well within its limit of a distribution. Uh, Investors can. There is practically no entry barrier, no exit barrier at all. Investors could actually invest into the funds and redeem from the funds at will, right? But you, as an investor, how you're going to measure your portfolio, how you would measure your performance is not what the fund is going to publish as part of its annual performance. Why is it so? Well, before actually delving into the mathematics, let's just again rankle our common sense and understand that when we talk about the fund and we talk about the fund manager effectively does not have any control whatsoever, especially in an open-ended fund like that of a mutual fund, when the investors would actually pull out their money from the fund or when the investors are going to put in additional investment into the fund. It could so happen that some of the investors may have a separate view from yours and they would want to actually pump in more of their hard-earned money into the fund because they perceive that the future forecasted returns are quite justified and the fund is obviously going to be a top performer in times to come. On the other hand, you might have a contrary view and you may not want to put in additional money. And in effect, you might have certain exigency because of which you want to liquidate some portion of your holdings. In either of these cases, the fund manager has zero to little say on how much money is going to exit the fund or how much money is going to enter the fund. Well, what's the point I'm trying to make? Well, all I'm saying is that when you think of your fund's performance, you should not think of the fund's performance. You should think of your portfolio's performance. And I think it's completely justified because a large portion of your portfolio's performance, after the background that I gave you, should be evident is obviously dependent upon a couple of things. And that couple of things are, first is the magnitude of the investment being made by a marginal investor. Second, the timing of that investment. It could be disinvestment as well. I'm just making things up out here, right? On the other hand, if you think of the fund manager is tasked with picking up the best investment possible under the given uh, under the given theme of the investment, right? So from the fund manager's perspective, the fund manager neither should be rewarded nor should be penalized because of the actions being taken by the individual investor, right? We just talked about it, which means that we need to find the rate of return for the same fund for two different people. So one is the investors community, which generally in other parlance, mostly with the closed-ended funds, is known as the limited partners. And you're going to learn a great deal about limited partner when you study the alternate investment. And another, of course, the fund manager in more often than not, who is termed as a general partner. All that I'm saying is that the same fund can actually yield two different results when we measure their performance. When you as an investor is actually adjudging the fund's performance, you should never judge the fund's performance by what the figures being published by the fund itself, because of these two constraints that we just talked about, right? So from that point of view, it's absolutely apt that you should separate the fund or the ethos of the fund from your own individual portfolio, and you should measure the performance of your portfolio in a separate manner. And the general partner or the fund manager out here, he or she should be adjudged, or his performance should be adjudged in a separate manner altogether. Why? Because under his control is only the selection of the financial securities, right? That's what is there as far as the mutual fund manager's area of work is concerned. Security selection, sector selection, theme selection, these are all the work and action of a fund manager. So he should only be adjudged to that scope of work only, which means that he should neither be rewarded nor should be penalized because of the action being taken by the investors. On the other hand, his performance should be measured about how true he stays to the theme of the fund itself. So from here itself, we understood that should be two different metrics to judge the performance of this given instrument in the market. We're talking about the same fund, but from two different perspectives. We're talking about the same problem, but from two different lenses, right? And this quagmire, this entanglement is what gives rise to two separate sorts of return. One is known as the time weighted rate of return, and another is known as the money weighted rate of return. Now, one way to think about this is that as far as the investors are concerned, they should judge their portfolio based on the money weighted rate of return. And as far as the fund manager is concerned, his performance of the portfolio over a multi-year period should be judged by something known as the time weighted rate of return. We're talking about the fund manager. However, there is a small caveat to this whole thing. Even though we talked about the open-ended funds floated in the capital market, time to time, there are funds in the market on which the capital call is the prerogative of the fund manager himself or herself. Under those circumstances, the fund manager should then be judged if the fund manager actually has a say and control about the timing of the cash inflows and the cash outflows and the magnitude of the cash inflows and outflows. In such circumstances, it is the money weighted rate of return also, which is the adept and adequate measure of the performance adjustment of the fund manager. Now, I know again, this may sound very heavy, very heady, because I gave you again a very big background to a problem. Now, before we get into the mathematics of it, the weeds of the mathematics of it, just to tell you that few things that you need to remember: money weighted rate of return is more suitable for investors, time weighted return is more suitable for the fund manager. The money weighted return is nothing but something called as the internal rate of return. Now, if you do not know what is internal rate of return, again, let me give you a little bit of an of a background. So let's say we are talking about a 3 years horizon. In this 3 year horizon, let's say you invest 100,000 US dollar in a given investment, right? So this investment is going to yield, let's say, X1 amount at the end of year one, X2 amount at the end of year two. I'm talking about in absolute sense. And let's say the terminal year is going to yield X3. The IRR is basically that rate of return that when we systematically discount each of this return and add them up, they are going to equate to the initial 100,000 investment that you made. In other words, if you recall the concept of the intrinsic worth of a given investment, when I said that if the compounding rate and the discounting rates are same, of course, your intrinsic worth is going to be zero. So IRR is basically that rate of return which makes the intrinsic worth of a given investment equal to zero. Okay, the money weighted rate of return is basically that internal rate of return only. On the other hand, the time weighted rate of return is known as the LIRR, or the linked internal rate of return. Sometimes it is also known as the chained internal rate of return. Enough with this theory. Let's first boil down to a given problem. So, a word of caution that whenever you are actually being whenever you actually face with any sort of problem based on the time weighted rate of return or money weighted rate of return, always this should serve you as Bible. Always draw the timelines, because if you're able to draw the timelines, half of your problem is anyway solved out there. And this goes true with any derivative problem that you're going to encounter across your CFA level 1, 2, or 3, as well as the fixed income problems as well. All right, so let's just dive into the problem that's there. And these are the ones that's actually going to separate the wheat from the chaff. We have to calculate the money weighted rate of return for a given investment. And how many timelines are being given? Well, if you think of it, I think all put together, we have uh, 1, 2, 3, 4. We have 4 timelines. So we are given the problem of an investor known as Kevin. And the time t is equal to 0 is the one where it is 1st of January 2020. And Kevin invests around $1,000 by purchasing the share of EasyCom. EasyCom is a fictitious company. I would not know if it's exists in real world, but that could be a very high degree of coincidence. So there are 10 shares that Kevin purchases of EasyCom at $100 a piece. That means he has invested $1,000 at time t is equal to 0. At the end of the first year, which is the beginning of the second year as well, EasyCom paid a dividend of 2 per share. It paid a dividend of 2 per share. That means there is a cash inflow of 2 into how many shares were being purchased? 2 into 10, or a $20 cash inflow has happened by means of dividend. Another year goes by. And now EasyCom pays another dividend, this time $4 per share. So this is around 4 into 10, or $40. On 1st of January 2022, which is coinciding with this date only, because always to remember, the borderline dates are always considered as one and the same. We really do not separate the borderline dates. It's a convention. So 31st of December 2021 is equivalent to 1st of January 2022. So Kevin purchases 5 more shares. 5 more shares Kevin purchases of EasyCom at $130 a share. Okay. So out here then, there is a cash outflow of 5 into $130 a piece, right? So which is around $650. Okay. $650. 31st of December 2022, EasyCom paid a dividend of $3 per share. So out here now, EasyCom would have made 3 into how many shares it has now all put together? It had initially purchased 10 shares at time t is equal to 0. At time t is equal to 2 at the end of year 2, he bought 5 more shares. That means all put together, he now has 15 shares, right? So with each of these shares, the cash inflow happens to be 45. Let's recheck once. Yes, $3 a share dividend was being paid, and all put together, he had 15 shares. So yeah, so 55 cash inflow has happened. And at the end of and at this year itself, that is on 1st of January 2023, this year itself, Kevin sold all the shares after receiving the dividends at 134 apiece. So that means he had an additional 134 multiplied by 5, 15, that is, which comes to around $134 into 15, so 2010. Okay, so all that we have done is we have mapped the cash flow, and I just revise once again. At time t is equal to 0, which happens to be the 1st of January, Kevin invested about $1,000 out here by purchasing 10 stock of EasyCom. A year down the line, those 10 stock pays $2 a dividend, so resulting in a cash inflow of $20. Another year down the line, a couple of things happened. First, the existing number of 10 shares paid a dividend of $4 each, thus accounting for cash inflow of $40. But at the same time, Kevin additionally purchased 5 shares, taking a $650 of cash outflow because of this additional buy. A year down the line, all the shares paid $3 dividend. Thus, Kevin, having $15, received a cash inflow of $45, and no sooner he got the dividend, he sold the share at $134 a piece, all 15 of them, resulting in a cash inflow of 2010 US dollar. We are to calculate the money weighted rate of return. Now, who is Kevin? First and foremost, Kevin is an investor. We have already got the cash flows. Now let's just summarize them. So we have got the cash flow 0 is equal to minus of 1,000. Cash flow 1 is going to be $20. Cash flow 2 is going to be $40 minus $650, which means a net outflow of $610. And the fourth cash flow, or the end of the year 3 cash flow, happens to be $45 plus $2010, taking the tally to $2055. So we've got all the 4 cash flows. All that we are required is to calculate the internal rate of return. Okay. Now, how to do it in your BA26 calculator? So I want you to open your calculator and press second and press the cash flow button. Just press press the cash flow button directly, and it is going to show you CF0. Now, if you have already certain data fed into it before, so that data is going to be shown up unless it has already been eradicated, eliminated. So you need to clear that memory once again. So whatever value is being shown out here, regardless of that, I want you to maintain the hygiene and press second and press CEC or clear work. Okay. So this will ensure that there are no remnant memory in your cash flow worksheet. So I've done this. Now my CF0 by default is 0. Now I need to press 1,000. You pressed 1,000. Press the plus minus sign and press enter. So once you do that, you're going to get the CF0 as $1,000. It's already being fed in your cash flow sheet. Press the down key, and you're going to come to CF1. In CF1, now I want you to enter 20 and press enter. Press 20 and press enter. Okay, you've fed the data 20 in your C01. If you press the down key again, you're going to come to something known as F01. F01 happens to be the frequency, and by default, it is going to show the value of 1. Leave it at that. Leave it at that as it is. Okay, do not tamper with it. Press the down key once again, and you're going to come to CF2. At CF2, I want you to now press 610 preceded with a plus minus sign, and press the key enter. Once you do that, that means in the CF2, you've fed the value of minus 610. Press the down key once again. F02 is going to show 1. Leave it as it is. Press the down key once again. You'll come to CF3, and at CF3, now I want you to press 2055 and key in the enter value. All right. So now what we have done is that in the cash flow sheet, we have entered all the relevant values. We have to find out the IRR. All that is required is simply press the IRR button and press the CPT button. Simply press the IRR button and press the CPT. Okay. Once you press the CPT, you're going to get a value of 11.81. And this 11.81 is also your MWRR, or money weighted rate of return. Okay, so I hope that through this exercise, you've got a very good hang of the MWRR. Now let's come to the next problem, which is about the time weighted rate of return. All right. So let's see what it says. A publicly traded fund had a market value of 100 on January 1, 2020. So there are certain narratives that's being presented out here. All that I want you to do is to, as before, create the timeline, draw the timeline. This is the most important piece of the whole problem. Whenever you're starting, that is t is equal to 0. All right. And that t is equal to 0 happens to be 1st of January, 2020. And on 1st of January, 2020, it's being said that the publicly traded fund has a market value, that is the asset under management, is equal to $100 million. $100 million. Okay. See how the perspective is going to quickly shift from the investor to that of the manager or the general partner. We are now not talking about a share, but we are talking about a fund. See the difference. Now, what it says is that in the first quarter, ending on March 31st, the fund had a capital, excuse me, had a capital appreciation of $12 million. All right. All right. So this about one full year. That's clear from here. Okay. All right. So all this says is that we are segregating essentially into 4 quarters of the fund. So this is my quarter 1. So I'm going to write this as t is equal to 0.25. So at t is equal to 0.25, which happens to be 31st of March 2020 oblique 1st of April 2020, as I said, that the borderline dates are to be treated as one and the same. The fund had a capital appreciation of 12 million. That means the fund, which was having a market value of 12 million, has now got a capital appreciation of 12 million and has effectively become 112 million. Okay. On 1st of April, the fund paid a dividend of $5. That was reinvested. The dividend is over and above the capital appreciation. Now, this is a very important aspect because we need to understand that dividends are normally paid out from the capital appreciation itself, realized in cash, of course. Sometimes dividends are paid out in terms of kinds, which are additional shares or additional units, but that's besides the point. But here it is being explicitly mentioned that the dividend is net of the capital appreciation. That means that the total appreciation has been actually 117. The total appreciation has been actually $17 million, of which 12 million is within the fund already being declared as capital appreciation, and 5 million was being declared as a dividend. However, that dividend was reinvested over in the fund itself. That means that there was no cash payout. This is an important aspect that I want you to understand out here. So there was a dividend of 5 million, effectively taking the capital to 117 million. Now, because of this superior performance, the fund attracted an additional investment of $30 million on 1st of April itself, thus raising the AUM to 147. Where this 147 came in, so we had already declared the 12 million of capital appreciation. We had a declared dividend of 5 million, which was again reinvested because none of the investors perhaps would have actually voted for the dividend being cashed out. Seeing the superior performance, external investors, maybe from the existing ones or the new ones, poured in another 30 million. We already had 100 million to begin with, as has been stated. So if we add all of them, of course, it's going to stump to $147 million. All right. So we have capital appreciation of 12 million, dividend being declared at 5 million, plus another investment, fresh investment of $30 million, taking the tally to $147 million. Okay. All of this happened on 31st of March, oblique 1st of April. All right. So from up till here, things are being sorted. Next, what it says is that on December 31st, the fund paid a cash dividend of 5.5 million and the ending value of the fund was 160 million. Okay, so now something spectacular has happened. What it says is that we were concerned about the first quarter, but beyond that time horizon, the quarter number 2, which is actually t is equal to 0.5, or quarter number 3, which is t is equal to 0.75 or 9 months, they really do not figure out because nothing actually happened in terms of the cash inflows or outflows. And there was obviously no evaluation exercise being performed apparently in between the intervening couple of quarters. It straight away takes us to the end of the year, wherein it is being declared that there is a cash dividend. There is a cash dividend. There is a dividend of $5.5 million. And the ending value, even after paying of the dividend, the ending value of the fund is actually $160 million. All right. So given this scenario, we are being asked to calculate the TWRR and also, if possible, calculate the MWRR as well. How to do it? All right. So as before, and as stated, that the TWRR is most suitable when we have to measure the performance of a fund manager. So here out, we're talking about funds, and it seems that majority of it is within the control of the fund manager, but for the timing of a huge cash inflow of $30 million that happened on 1st of April. So we now need to see that how do we treat that thing? Okay, how do we get around that thing? Because as we stated before, that the fund manager should not be rewarded or penalized because of the magnitude of the cash inflows and outflows happen, which are not the prerogative or under control of the fund manager or the timing of it. I hope you remember that golden principle. So now going by this, how do we calculate the TWRR? Now there is a simple formula for TWRR which says that all that you need to do, TWRR is basically the linked internal rate of return or the geo mean. And in order to find out the geo mean, what did we do? Yes, you guessed it right. We just simply take the 1 plus holding period return that's there, assuming there are n number of returns. So holding period 1 into holding period 2 into so on and so forth up to holding period, nth period of holding. And then thereby taking 1 by n and deducting 1 from this. That's it. All right, so we have got the timelines sorted out. All that we need to do is to break it down into 2 parts. First is to calculate the individual holding period of return and then simply link it. Now, as you would know, as I've stated before, the holding period is time insensitive. It is never annualized per se, right? So in the first case, how do we calculate the holding period return? So we have got the ending value at the end of the first quarter. And we've got the beginning value. Okay. So in this case, the holding period return happens to be 112 because this was the capital appreciation, $12 million plus another 5 million. This was the dividend which got reinvested divided by the initial investment of 100 minus 1, right? So this becomes 17%. But hold on. If you look at the right-hand side of the expression, it talks about 1 plus HPR, 1 plus HPR at each of this instance, which means that we would be better left without deducting this one. It's just a mathematical exercise that we're doing, okay? Because at the end of it, we again will have to 1 plus HPR. 1 plus HPR would mean 1 plus 17% or 1.17. So I hope you get the point. All right. So the first period, 1 plus HPR happens to be 1.17. Similarly, we can calculate the holding period return. This is the first period. Now we have to calculate the holding period return for the second period. But here comes the twist. The holding period return for the second period, of course, we cannot consider quarter number 2 or quarter number 3 because no data are being given for these 2 quarters. Neither it is being stated that there has been any valuation exercise being done for these 2 quarters. It directly takes us to the end of the year. And at the end of the year, we see that the fund had an ending value of 160 plus it had declared a dividend of 5.5. Of course, we are going to calculate 1 plus HPR. We are talking about this is the first period. Now we are talking about the second period. And there are only 2 periods out here. Now comes the denominator. And now in the denominator, you need to understand that we cannot put the previous 100 because this previous 100 was the principal at time t is equal to 0. And it served well as the denominator between time t is equal to 0 and time t is equal to 0.25 of the first quarter. However, at the end of the first quarter, the total invested capital happens to be 147 million. Where this 147 million came into picture from this equation, you would know $12 million of capital appreciation, $5 million of dividend, and $30 million of external investment. So we need to take that all of that into account because all of them work towards creating this ending value of 160 plus 5.5. So your denominator becomes 147. And if you solve this, you're going to get a value of 1.125. Good enough. Now, if we have to take out the TWRR, we could simply multiply this by 1.17 into 1.125. Okay. Now, in this case, we did not explicitly put this bracket because it's just about 1 year we are talking about, right? If you could see, we're just talking about 1 full year. So, of course, 0.25 quarter and 0.75 quarter. 0.75, how it is 0.75? Because beyond the first quarter, there's one more quarter, and last. So there are 3 quarters remaining, which makes up 0.75. All right, 0.75 year, right? So the first quarter is 0.25 year, and the next 3 quarters put together is 0.75 year. Of course, you can understand when we are going to put this in power, they're going to eventually add up to 1. So in this case, there is no need for us to separately, put in this hood. We could simply take the multiplicative term and then deduct 1 from here, so which becomes 1.17 into 1. Okay, we've already done this. So this, if you work through, is going to give you a result of 31.72%. All right. So from here, let's also calculate the money weighted rate of return. And this should be pretty easy. I'm not going to redraw the cash flow matrix. It should be pretty evident to you. The CF0 happens to be minus 100. The CF1 happens to be minus 30. Why it's minus 30? Because $30 million of fresh investment had actually come into picture. And now one more aspect that I need to tell you is CF2 should be 0, CF3 should be 0, and CF4 should be 165.5. Now I know that out here you would be surprised about the introduction of CF2 and CF3. Where did this come from? Well, this is another difference between the TWRR and MWRR return measures. As I said before, that the TWRR is insensitive to the amount or the magnitude of the return being made. Secondly, it is actually the linked internal rate of return, which is nothing but the geometric mean of the change ruled uh, return, which again does not depend upon the time period. We could link a time period of 1 quarter, that is 3 months, with with another time period, which is of 9 months. Okay, but when it comes to your MWRR return measures, and especially when you'll have to work through the cash flow worksheet that's there in your TIBA2 plus, you need to understand that the MWRR will only work when the time periods are all equally spaced, right? This is a major difference between TWRR and MWRR, which means that if we are considering quarter 1 for this particular problem, if you're considering quarter 1, we necessarily will have to consider quarter 2 and quarter 3 as well, in addition to quarter 4, even if there has not been any cash inflows or outflows, there has not been any cash fresh investment being made or any dividend being released by the fund. We still have to take these 2 quarters into account because of the even space that we need to impart to the time period. Otherwise, your cash flow worksheet will not work. So this is one important trick or one important aspect that you need to take into account. So once you understand this, and this is again one major point of difference between the MWRR return and the TWRR return. So once you've got a hang of this, the rest of the thing is actually putting in the value into your cash flow worksheet. And I'm sure that by now you would know how to do it. I'm not going to get into the details of it. And if you work through, you're going to get a CPT. You're going to get a CPT IRR when you do. When you get the CPT IRR, you're going to get a value of 6.6%. But hold on. This 6.6% value that you're going to get, it is again on the basis of the quarter that we have just talked about. We need to find out the annualized return, right? So in order to find out the annualized return, what you need to do is first and foremost calculate this 6.6%, convert this into decimal first. So this becomes 0.066. Add 1 to that so that this becomes 1.066. Raise it to the power 4. And then deduct 1 from it. If you do that, you're going to get the value of 29.15%. Now, do not be confused. Do not be bogged down by the operation that I did. All I did was convert a quarterly return to an annualized, effective annualized return. We've already discussed how to do it, how to use your calculator to convert an annualized return to convert to change from one interest rate regime to another interest rate regime. We already have talked about this. I just used a shortcut to do that. That's all there is to it. Okay, so this is where you need to be mindful. And I let me tell you that I have perhaps picked up the hardest of the examples, which are there in the CFI textbook, or it's not there in the CFI textbooks, with the objective that if you learn from this, it's nigh impossible that you would not get the concept. Even the most trickiest of the problems that might show up, I can assure you that if you get a hang of it, if you are able to solve these problems by your own self, save the calculation error, there is no chance on earth that you can make any mistake. All right, so that being said, let's just discuss a few of the differences between the TWRR and the MWRR returns. A majority of it we have already discussed. For example, And I rather, I leave this slide to you, pause this portion of the video, judge for yourself, look out for it, judge for yourself, understand what's being talked about. Let me tell you that this is not again contained in your CFI textbook explicitly, but there is a probability, there is a chance that one or two questions might be based out of this, taking some finer cues from the slide that's in front of you, and such questions might be framed in your actual exam. Uh, there is a last bit of a problem that's there, wherein the MWRR and the TWRR is being talked about. Again, all that I'm going to do is to draw the timelines, but before that, you know, just read through the text once. An investor has the following investment being made, reflected in the cash flows in the publicly traded fund. She bought 5,000 units of the fund each period at an NAV of USD20, thus investing a total of $100,000. That is in year one, year zero. And the fund declared a dividend of USD2 per unit, while the value appreciated to USD25 per unit post dividend, explicitly mentioned. Year two, at the end of year two, the investor bought another 2,000 units at $30. And at year three, she received $5 dividend for all the units. And at the end of year three, she sold her entire 7,000 units at 32 per unit. And in this case, we had to find out the MWRR for the investor and the TWRR for the fund. All right. So let me just create the timeline. We have 4 periods starting from t is equal to 0. And in this period, the investment that is being made is $100,000. And the AUM is also reflected to be $100,000 because we do not have information about the fund's size overall. So we're going to consider the investor being the sole investor to the fund itself. And at time t is equal to 1, there is a capital appreciation plus there is a dividend. So dividend happens to be 10,000, and the capital appreciation happens to be from 20 turned out to be 25. So the capital appreciation takes the fund from 100,000 to 125,000, purely capital appreciation. And then there is a cash inflow of dividends that is around 10,000. All right, that is at time t is equal to 1. So the AUM remains at 125,000, while the cash outflow happens of $10,000. And at the end of year 2, the investor had purchased another 3,000 units. So there is a cash outflow from the investor's perspective. Remember, this timeline is from the point of view of the investor, which is to say that the fund manager's cash inflows and outflows sign will be exactly the mirror image of what is being shown out here. And the total AUM after the infusion of the 16,000 will now become $210,000 because there is a capital appreciation as well at the end of year 2. The price jumped from USD25 to 30. So earlier the investor had 5,000 units. So 5,000 units, if you multiply it by 30, becomes your 150,000, 150,000 plus 60,000. That is how this becomes AUM 210,000. So I hope you understand how this 210,000 came into being. There is a capital appreciation while the price of the share jumped from the NAV jumped from 25 to 30 because of he was holding 5,000 units. So the total AUM becomes 150,000 because of the price jump from price appreciation from 25 to 30. Plus there is an additional investment of 60,000 US dollar. That makes the AUM at the end of year 2 asset under management at $210,000. And at the end of the year 3, there is a complete redemption that's happening because he sells the entire unit and receives 224,000 US dollar as part of the capital gains and $35,000 as part of the dividend. Okay. Sorry. The total he sells the total number of all 7,000 units at $32. So $32, if we take, so this one 224,000, of course, and so received as dividends of 5 as well. So 5 and 7 to 35,000. That's correct. So now all that you need to do is to put in the cash flows accordingly. CF0 happens to be minus 100,000. Again, at the cost of repetition, this worksheet is being worked out from the point of view of investor. If you work out from the point of view of the fund manager, the signs would simply change. This becomes 259,000. Now, at the end of year 3, you must understand that this is going to be entirely minus. Why? Because there is a complete redemption that's happening. The fund is dissolved. He's the sole investor in this particular fund, and that is the reason that the fund, once it's being dissolved, the entire money is being cashed out. So the fund loses its entire capital while the investor gets the entire capital. So it's a cash inflow as far as the investor is concerned. It's a cash outflow as far as the fund is concerned. All right, so we have gotten all the cash flows. The rest of it is easy. Simply feed in the value and ask the calculator to calculate the IRR. And your calculator, if you have fed the data correctly, is going to throw you a value of 25.85%. All right, 25.8%. So this is your MWRR. What about the TWRR? So we could set out the same example and calculate the holding period return. And I think that you can understand that the holding period return, the first holding period return, happens to be 35%. How it is 35%? $25,000 of capital appreciation plus $10,000 of dividend being paid. So this becomes 1.35. If you do a similar exercise for the holding period number 2, you're going to get a value of 1.2. And for the similar reason, the holding period value of 1 for the year 3, these are all 1 plus, 1 plus, 1 plus. Okay. So this, you're going to get a value of 1.23. So the rest of the things are easy. If you have to find out the TWRR for 3 years, we have to take out the 1/3 root, and in under the hood, we'll have to multiply all the values that we have got. That is 1.35 into 1.2 into 1.23, and suitably deduct the 1 from here. And if you do so, you're again going to end up with a value of 25.8%. So in this particular case, the TWRR and the MWRR, they are exactly coinciding. The reason out here why it is coinciding is because the fund manager and the investor are exactly the mirror image of each other. It's being so perceived that there is this fund is solely being created for the fund for the loan investor, and there are just no other investors to this particular fund, and that is the reason that all the calculations are simply a mirror image of the same, which also bolsters the fact that all our calculations have also been absolutely correct and on the spot. So I hope that through this extensive 3 examples that I gave, and if you have practiced this example, it's, as I said, that it's going to be almost impossible, save your calculation error, to make any mistake. All right, so you would already know how to analyze the return. We just did that. I don't think I need to talk about it. The continuously compounded rate example, we're going to practice a few if you want me to do, and that's pretty easy. We can do it. But before that, let's talk about certain return measures, other return measures. So the gross return is basically what the fund actually can generate before the management fees are being paid, but after the trading expenses. The net returns are basically the return of the management fees and administrative expenses. So we must understand when we are talking about funds, and then there is an investor, what the fund generates as part of its return, those returns are always gross in nature. Okay. This also includes the trading expenses. Why the trading expenses? Because these trading expenses are not pertinent to this particular fund manager, but these trading expenses are extraneous to it. These are basically the fees that are being paid, that are being uh, paid to the exchanges, the clearing agent, and all other capital market agents that are there. So there are certain exchange fees. So those exchange fees are inclusive of the gross return. The net return are the return that is being calculated after the management fees and administrative expenses. Of course, this fund manager is not running a charity. There are going to be fees and administrative expenses. Those are being deducted, and that's what is known as the net return. But hold on, your net return that you get as part of investor, they're also your pre-tax return, because a fund cannot predict what your marginal tax rate is, right? So your pre-tax return is your net return. Of course, depending upon the tax jurisdiction, depending upon your marginal tax rate, you would then calculate that what's the tax that you're ought to pay and what's going to be the post-tax return at your end. You already have a good bit of a notion of what is meant by a real return. This is the return that we get after adjusting for inflation. A new concept is being introduced, which is known as the leveraged return, and I'm going to talk about it in a little while. Just know this, that not all investments are being funded through the investor's equity. Sometimes the investors can actually collateralize the investment portfolio, and the bank or any lending institution may finance the rest of it. All right. Remember, we talked about choosing between two uh, investment options, wherein one was paying you on a quarterly basis, another was paying you on a semi-annual basis. Which one to choose? How do we do that? We come out with something called as effective annualized rate. So we calculate the EAR for each of this investment, and then we choose the one that actually yields more. Okay. So this happens to be the primary equation of the same. And again, as before, I'm not a very big fan of any stylized equation, because I believe that people trying to simply resort to mugging of those equations, they actually do not internalize, or they really do not uh, develop this cognitive consciousness to learn and embed the concept internally. So unless you internalize, it's actually a futile exercise to memorize an equation. But then, for brevity's sake, because it's as part of your curriculum, it's there. So I am bound to actually at least make this expression available to you. But if you understand the concept as we have learned, there is no need for you to memorize anything out here. You would already know how to calculate the effective interest rate, right? So I want to now, these interest rates that we talked so far, they were discrete interest rates in nature. We also did fleetingly mentioned about the continuous compounding interest rates. And the continuous compounding interest rate and discrete compounding interest rate, even between them, there is a certain relationship. In other words, we can change the regime from a continuous compounding to a discrete compounding and vice versa. It's another way of saying that we can find out the equivalent of one in another regime. How to do it? So for example, I'm simply going to make use of our calculator rather than again going through the rigmarole of explaining a formula, not required. What it is being said is, what is the effective 6%, what is the equivalent of 6% effective rate if compounded on a continuous basis? Of course, since no other information is there, this is annualized. That's what we are going to assume. So all that we are going to do is whenever you have to convert convert from a discrete compounding to continuous compounding. continuous compounding. So visually, it's like this. I do not know how many compounding periods are there. There could be n number of compounding periods, but they are all discrete in nature. Versus a continuous compounding, which looks like this, with infinite periods in between the given time frame. But if you want to change from one to another, how to do it? So for this particular thing, I'll show you. There are 3 steps to it. The first step is that you add 1 to the given interest rate. In this case, happens to be 6%. In fact, there are only 2 steps. So this is step number 1. Add 1 plus 6%. This becomes 1.06. And step number 2, press the ln button on your TI-BA2 plus calculator. Remember, at the cost of repetition, I am, whatever syntax I am talking about or I'm demonstrating, they are relevant to only the TI-BA2 plus calculator. The CFA Institute, in addition to the TI-BA2 plus, also allows the Hewlett-Packard HC12 calculator as well. I've never used it. I do not know how it functions, how the syntax actually play around. So I'll not be the best judge to talk about it. But in the TI-BA2 plus, which I believe the majority of the students and the candidates, they do use, this is how things are being done. So if you want to calculate the equivalent of 6% effective rate, which is going to be compounded on a continuous basis, this 6% effective interest rate is being given in a discrete manner. So this is how you go about it. There are only 2 steps to it. One is, the first step is to add 1 to it and convert it into decimal, and second is press simply the ln button. And if you press ln button, you're going to get a value of 0.0582. At all, if you have to add in the third step, it's all about converting the decimal to percentage, which is equivalent to 5.82%. All right. The second question asks, if the continuously quarterly compound rate is 7%, what is the effective discrete rate? Now, this question is a little deceptive and may seem a little out of the blue. It says continuously compounded, but on a quarterly fashion. So it seems it gets compounded once, and then again, it gets compounded again, and then again, it gets compounded for the third quarter, and then again, it gets compounded in the third quarter. But do remember, at each of these stages, they are anyway getting compounded. So that means that a continuously monthly compounded, a continuously quarterly compounded, a continuously annually compounded, they're all the same, because there is no separate distinction because of the infinitesimally small intervening period. In a continuous compounded manner means there are infinite periods. So it doesn't really matter that it is a continuously compounded on a quarterly basis, half-yearly basis, monthly basis, daily basis. They're always going to be annualized. So it's being stated that if the continuously compounded rate is 7%, what is the effective discrete rate? Now, you may intuitively understand that this particular problem is just the reverse of the first problem that we solved. So, can we do it? The answer to that is yes, we could. And in fact, it's pretty easy to do it. Okay, again, there are only 3 steps that are to be taken. The first step is convert your 7% into decimal. Okay, so this becomes your 0.0. In fact, there are 4 steps to it, so to speak. 0.07. The second step is press the button second and press the ln. All that you're doing is taking the anti-log of the given value, because to remember, this 7% is on a continuous compounding, not on discrete compounding. We are to revert to discrete compounding from the given continuous compounding. So I want you to press second and press ln, and you're going to get a value of 1.0725. The step number 3 is a deduct 1 from 1.0725 or whatever the factor comes in. And there you go. Step number 4, you're going to get a value of 7.25%. So from these 2 exercises, one thing is clear. All other things remaining constant, for the same yield, the discrete rate needs to be proportionately higher than the continuously compounded rate. Of course, that's again no-brainer, because effectively, the continuously compounded means that there are infinite periods that we are working on. So obviously, the yield is going to be somewhat more with a lower rate of interest. The equivalent interest rate in discrete will obviously have lesser number of periods. That means we need to compensate for those lesser number of periods by attesting a little bit higher interest rate. But the difference is not going to be huge. They're going to be minuscule. So 6% discrete compounded effective rate is equivalent to 5.82% continuously compounded rate. Continuously compounded rate of 7% is equivalent to 7.25% discrete compounding rate. All right, so the next question asks, if the discrete quarterly compounded interest rate is 6%, what is the equivalent continuously compounded rate? Now, this is a little bit of a challenge because we need to break this problem into two halves. The first half is all about getting the EAR. Why we need to EAR? Because it says that the discrete quarterly compound interest rate is 6%. So that means each quarter corresponds to 6% divided by 4 or 1.5%. Okay, so each of this quarter is being compounded at 1.5%, and then we have to find out the equivalent continuously compounded rate. Obviously, the continuously compounded rate is always annualized. There is no way you could break it down to monthly, daily, or half-yearly period, any period you can think of. Precisely why it is called continuously compounding. So in this particular case, we will have to first find out the effective annualized rate for a 6% quarterly compounded. And once we have found that rate, then the second step is to convert the discrete rate into continuous rate. So all that we do is make use of your second and icon function. I think we have already done that. Icon function, right? All right. Clear the memory. That means second and press the button 2. And then second and press the button CEC. So you're clearing the memory. Once you clear the memory, you're going to get a norm of 0. And I want you to put the value of 6 into this. The rest of the steps are easy. Press the down key once. You're going to get the EF. It is going to be shown as a 0 by default. Ignore it. Press the down key once again. You're going to come back to the compounding frequency of C by Y. Put the C by Y compounding frequency as 4. And then press the up key once. You're going to come to the effective interest rate and then press the CPT button. And you're going to get a value of 6.13%, 6.136% to be precise. This is the effective annualized interest rate for a 6% discretely quarterly compounded interest rate. Okay, sounds fuzzy? Well, live with it. So now we have solved the first part of the problem. The second part of the problem is to convert this into the continuous rate. So all that we do is to follow this, the 3 steps mentioned in the problem number 1, and that is we add 1 plus 6.136%, making it 1.6136, and then simply take the ln. If you press the ln button, it is going to show you a value of 5.95%. I'm jumping a step, of course. Now, again, at the cost of repetition, that these 3 problems that I did, they're, of course, of paramount importance because they embed a lot many concepts, discrete to quarterly, discrete to continuous compounding, and vice versa, with the twist of multiple compounding periods. All right. So these are already discussed. I'm not going to spend much time in this. You could pause this portion of the video and see for yourself. Now we come to the last portion, and that is the leveraged return. What is meant by leverage return? So, as I said before, that investments that are being made by an investor, the investor really has got a couple of choices. One is to put the 100% equity, and another is to borrow significant portion. I do not know what that portion is. Let's say that is X%. And that, of course, immediately would require less amount of initial equity. Now, where is the catch? So if your anticipation is correct, the investor's overall return is going to amplify. Why it will amplify? Well, it will amplify because he will effectively be putting in lesser money of his, or lesser equity, so to speak, and will be garnering more return. How is it so? Let's just solve the problem first without getting into the myriad and labyrinth of formula. So I read out the question. An equity portfolio with a value of 5 million earns a profit of 8%. If the portfolio uses 3 million of borrowed funds at the cost of 4%, what is the leveraged return of the portfolio? Forget about any of the formula that you're tempted to look at. Use your common sense and solve the problem. So V0 has got a value of 5 million. If it earns a return of 8% effectively in an absolute term, it would mean around 0.4 million it would earn on this portfolio. However, it's being also stated that this 5 million is being funded by 3 million borrowed at 4%. So 3 million, if it is borrowed by 4%, it would mean it is going to cost around 0.12 million. Okay. So now effectively what has happened, let's see. The investor funded a portfolio which was valued at 5 million by putting in his own equity of $2 million and borrowing 3 million. Thus, his total investment became 5 million. This 5 million over a period of 1 year earned him $4.4 million. Of course, at the end of the year, the investor will first require to retire the debt he has taken from the bank. So this portfolio is deemed to be liquidated. He will recover his equity as well. So the 3 million, of course, will be paid back to the bank. In addition, 0.2 million will have to be paid as part of the interest. Where this 0.2 million is going to come from? This 0.2 million is going to come from the overall gain the investor had from the return measure itself, which means at the end of the year, after deducting this interest that is required to be paid to the bank, the investor is now left with the gain for the investor is going to be 0.4 minus 0.12 or equal to 0.28. So this is the investor's net gain. Of course, taxes are not being considered out here because they're just not mentioned. So obviously all these returns are on a pre-tax basis. So if you consider now, the investor had put in 2 million of his equity, and through this construct, he earned 0.28 million. So his overall return is equal to 0.28 divided by 2 or 14%. Okay. The fund had returned only 8%. However, because of the clever strategy that the investor adopted by borrowing suitably, he amplified his return and this 8% became 14%. This is what is known as leveraged return. Now, understand this. We did not use a single formula. We used the initial value, calculated the overall return, calculated the liability that the investor has to return to the bank, and then whatever was net remaining after retiring that liability along with the interest becomes the investor's gain. And that whole thing is now being represented out here through this formula. RL is equal to the leveraged return. We call this now the leveraged return. This 14% is the leveraged return, is equal to the portfolio return plus a ratio of the borrowed fund and that of the equity multiplied by the portfolio's return minus the cost of borrowing itself. Okay, this is what is leveraged return all about. Now, whether you want to memorize the formula or you want to solve it through the common sense of yours, I leave that judgment to you altogether. But I hope that through this extensive exercise that we did, the entire concept was well cemented, well understood. All that we are left out is solved through some of the concepts, checkers that's there with the CFA Institute's book. And I've picked up some of the best problems from there. All that I'm going to do is to solve these problems along with you so that it becomes all the more clearer to all of you in the part 3 and the concluding part of this presentation. So stay tuned for the part 3 of the presentation.